cabling here. And we are live. What's going on, everyone? This is the Kwak Brothers, Sam Kwak here. My name is Daniel. You might want to lean forward, Daniel, because you're out of focus. There we go.
Can they not hear me?
No, you're out of focus. That's what's happening.
I'm out of focus.
So, guys, we're going to be doing this every single week on Mondays between 11 a.m. to 12 p.m. Central Time. You may just go with 11:30 Central Time, depending on how many people we get on the live. But we're also working on a few more things, such as you guys being able to call us, and we'll be able to take calls and answer questions while you guys speak. We don't have that feature just yet. We are going to have that starting next week. But we want to get a head start in answering some of the questions that you may have. So,
all right. Well, now that you're done talking,
if
you look at the video, it actually looks like the ad for when, like, before marijuana use and after marijuana use.
No,
you're very clear, and I'm very blurry.
Let me get him on focus real quick.
True focus. Right. Get him on true focus. How about now? There we go. Oh my goodness, you can see my everything. You can see my skin.
There we go.
This is a little scary.
Yeah.
Oh, look at that. Even you're more focused.
Yeah, there you go.
It's
like we just used Claritin, and now we're like super clear.
Claritin's more for your nose.
No, it's allergies in general.
Yeah.
Guys, go ahead and shoot your questions. We're gonna go and pay attention to the chat box area. If you have any questions about real estate investing, whether it's owner financing, raising capital, finding deals, like what do you do? Like how do you find deals in a hard market? Right? That's a
ask away.
Question. Yeah, ask away. So we're gonna be paying attention to the comment section below, and you probably won't find like a lot of opportunities where Daniel and I are both together answering questions. Whether it's a question about the HELOC strategy, which actually we're gonna have a dedicated day just for the HELOC strategy because I know it's super popular.
In our channel, yes.
Yeah,
it's the most popular video.
And this Mondays we're gonna be dedicating the time for real estate questions. So I know a lot of you guys, it's 11 a.m. Central Time, so it's 9 a.m. for you guys in California, and it's lunchtime for you guys in New York. And there it is.
Yeah.
Is this still a good time to buy real estate?
I have a question.
Yes,
so this is episode 1. I have the first question. When it says 11, does that mean 11 million?
No, 11 people.
11 people are watching. That's pretty good. Okay, so Lone Newton. What a great name for real estate. Lone Newton. Is this still a good time to buy real estate? China is treating our econ. So that depends, right? So one of the things that I really love is economics. And, Sam and I had the opportunity to travel to a lot of different places around the country, particularly me, travel around the country. Sorry, I'm like, want to look at the screen and want to look at this at the same time. But, obviously we had a lot of opportunities to travel across the country. And for me in particular, I traveled a lot just for real estate investing training. I mean, there were points where I was on 5-6 flights a week. And one of the things that we commonly talked about was the importance of, thank you, appreciate it. One of the things that I commonly saw was individuals who come to me afterwards and say, man, Daniel, I remember when I used to have this. I used to have 50 houses. I used to have 200 houses. I used to have, thanks, man.
There you go.
I used to have this. And that just it became a common trend. It became a pattern. Right. And I noticed every single city I go to. Right. And then he could probably say if that happened to him as well. But a lot of people started coming up to me and say, like, oh, man, like, I remember I used to have this, and this. And I started asking myself, why is it? Why is it that these guys have, used to own a lot of these things, but they lost it all or whatever happened, so to speak. And for me, like, I am more interested in why people fail than why people succeed. I think success is easy.
Mm-hmm.
You know what I mean? Like, we know how to handle success. We know how to handle the good stuff.
Right.
You don't have to tell us to, like, you don't have to tell, yourself to enjoy a massage. We already know how to do that, but how do you deal with the hard stuff? How do you deal with the downside, the negative aspects? So I became really interested and kind of obsessed and really curious, so to speak, on why people failed. And it seemed to me that time and time again, one of the most common reasons as to why real estate investors did not achieve their goal. And not only that, but they lost a lot of their assets or they lost other people's money was because they did not understand the concept of chronological economics. Now, let's break that down. Chronological economics. That means economics from a standpoint of time, right? Not right now to where we're seeing the big picture, because a lot of people make decisions on deals based on right now. So, to kind of answer your question, I wanted to set that framework, Loan. Is this a good time to buy in real estate? You know, that honestly, it depends, because right now I can find an off-market deal, right? For example, I'm working on an off-market deal right now. I'm buying a rather large portfolio of 48 properties in phase 1, and then we're buying an additional 150 properties in phase 2, 3, and 4. It's like Marvel, you know,
Yeah.
we're like the Russo brothers, you know what I mean, in different phases. But right now I'm buying a rather large portfolio, but I'm buying an $8 or $9 million value in just a phase 1. That's the value of phase 1, and we're buying it for 3.5 million.
Yeah.
So, you know, is this a good time? Well, yeah, my question back at you would be, you know, like, how good are you at finding these off-market transactions? And additionally, how good are you at adding value to the other person to the point where you can actually create an amazing deal for them and also for you? But chronological economics, that is such a huge thing you have to study. Asking the question of, is this, because we can look at a deal and we could say, all right, here's the income, and then here's the expenses, and here's our, you know, debt service, and here's our cash flow. We can do that right now, but I would challenge you and ask you, what does that look like? What does that same formula, what do those numbers look like 5 years from now, 10 years from now?
Yeah.
You know?
Yeah, which actually leads to a question. So big Kutch?
Big Church?
Yeah, big Kutch Lopez here.
Lopez?
Yeah,
Lopez. Okay, cool.
Yeah, so big Kutch Lopez is saying, how do you see housing market in the next 5 years? That's you.
How do I see the next housing market in 5 years? So let's take into consideration kind of the most big important factors that we see in the economics of today. Right now, the housing market is totally contingent on what's called supply and demand. So obviously, we all know what supply and demand is. But when you're asking the question, Mr. and Mrs.
Lopez.
Yeah, Mr. or Mrs. Lopez. I'm going to call you George, right? George, what you're really asking is, you know, what is the supply and demand going to look like in 5 years for us as real estate investors, right? Because unless there is a supply and demand, unless there's no demand, we cannot supply the exit strategy. Unless there's a demand for people wanting new houses and new construction, why do a fix and flip? You know, if there's no demand for people wanting to live in apartments, why buy apartment buildings? So in 5 years, let's break down 3 of the biggest economic factors that right now that we could kind of say, all right, this is the direction that we're looking at here. This is the direction where we're kind of seeing in terms of what's heading. So number 1 is obviously the interest rate. Now, a lot of people, whether you go on CNN or CNBC. Now, I would recommend, if you're looking to study and research the market, do not go to CNN or CNBC or Fox News, whatever. Do not go. I would recommend reading research reports from big realty firms like Marcus & Millichap. They put out a lot of great research reports. I know the NAR put a lot of research reports if you have a license, which we don't. And that's a topic for another conversation or another day. But, you know, look at the research report, study the data. You know, so much of us as real estate investors and entrepreneurs, one of the biggest important skills that we possess is able to look at data, able to look at the facts and figures and come up with our own opinions rather than turning on, you know, CNBC or whatever and, you know, hearing somebody else's opinion. We do not want that, right? So first thing is the interest rate, right? We can safely assume that interest rates are going to slowly go up in the next 2, 3, 4, 5 potential years, right? We can safely admit that. Unless there's a huge correction that's going to happen in 2 years or a year and a half, which I think is going to happen. And for some reason, the administration of that presidency at that time, whether it be the Trump presidency or somebody else's presidency, depending on what they do, that's going to impact what the housing market's going to look like in 5 years. They may do what the Obama administration did and lower the interest rates all the way down to 0 or almost 0, but basically 0 for like 8 years, right? That's what the Obama administration did. When 2008 happened, they lowered the interest rates all the way down to 0 from the Federal Reserve standpoint. And not only that, but they issued government bonds for 3, 4, 5 consecutive years at dang 0%. That's how you extremely put cash into an economy. I'm not going to say overinflate, right? Because I feel like that's a word that a lot of people don't get correctly in terms of their perspective. But in terms of putting cash into economy, that's how you do it at an extremely rapid pace. I don't know if that's good for the economy or not. Time will tell. Yeah. But in 5 years, I think we're either going to be in a position where money is again back down at 0% and we're on the rise, because you're talking about 2024. And we see a very similar situation to where we saw in 2012, where the market starts picking back up slowly.
Yeah. So I'm going to translate in the layman's term.
Yeah.
In the layman's term, money is going to be cheaper. If what Daniel was saying is going to happen in 5 years. So if I can go down the bank and say get a loan for 2%, which I don't think is going to happen, but let's say it does happen. Holy smokes, everyone's going to run and get the money because money is cheap. Doesn't cost anyone money to go get it. So what happens if everyone can buy real estate? Well, that means that price is going to go back up. Now, before we can handle the next question from Romain Kono.
So let me finish Lopez's question.
Yeah, no, go for it. Yeah.
So that's the first one, interest rate. So basically what Sam was saying, and he's a lot like my translator. So because I talk
Simplify,
a lot,
baby. Simplify.
like in terms, right? Yeah. And higher level. I guess I don't want to say higher level because I don't want to come across as, I'm like Ben Shapiro. He's like Steven Crowder in terms of how we communicate, right? So
make it very easy to understand.
There you go. Make it very easy to understand. So long story short, right? The money is either going to be really, really cheap, right? Or we're going to be in a position where houses portfolios are going to be easier to buy from kind of like a short sale or foreclosure perspective because of how cheap the money was, right? So the second concept also, so we have interest rates and also we have bonds, which is long story short, what the government did to put cash back into the economy, they issued what's called bonds. Bonds is a fancy word for IOUs, right? But they issued at a very cheap percentage rate, which means that now these bonds are more expensive because the debt is worth more because of the higher interest rate. Now, we're going to be in a position about a year and a half from now in 2020 to where these bonds are going to come due. So imagine, right, having a mortgage or having a note, you borrowed money for 10 years at 0%. Now it's at 4%. It's 10 years later and you have to pay that money back.
Right.
So we're going to be in a very interesting position, so to speak, where the housing market may reflect because of how integrated and how close the government and the real estate market is now because of these programs like FHA, right? The first time home buyer. And then we have Freddie Mac, which, by the way, guys, when it comes to multifamily and apartment complex, did you guys know that Freddie Mac is the largest financer of these investment properties?
Well, we got to explain who Freddie Mac is.
So Freddie Mac is basically the government's, government loaning money for people to buy investment properties.
It's kind of like the government loaning money for student loans. Like
exactly.
The Department
like
of
Fannie Mae.
Yeah,
right?
The Department of Education is loaning out literally billions of dollars every year. And our confidence of our millennial friends paying those back very slim to low, and I don't see a very bright future with student loans. But anyways,
no, you're absolutely right. Absolutely right.
So before we get to the next question, we do want to remind you guys we're going to be doing this every single Monday, or we're going to try to get to every Monday. For us to do this and for us to be motivated to do this, make sure you guys subscribe to our YouTube channel. If you guys haven't done so, which will notify you, by the way. If you do subscribe, you will be notified when we go live and when we don't. So be sure to subscribe to the channel, hit the bell icon so that you guys get notified whenever we go on. And chances are you want to get your questions answered live instead of free. Right, and it's free, absolutely. So let's go ahead and hit the next question. Roman's asking, what do you think about $60,000 in Wall Street or buying an investment property? Yeah.
I think that depends on your skill level.
Yeah.
If you're an amateur real estate investor, I don't want to use the word amateur, but if you're just starting out, I would use that $60,000 towards some of that $60,000, not the whole thing, but I would spend that $60,000 towards actually educating yourself. Now that doesn't mean going out and buying, a $30,000 or $40,000 real estate investing education company. No, I'm talking about putting yourself in the position where, I would hire a coach, right? Hire a one-on-one coach to help you, who's going to actually, help you do all these things. Spend that money on books, on real estate investing education program. Obviously that leads me to say we have ours.
Yeah, it really leaves me in a disappointment when someone asks, Sam, what do I invest in? Do I invest in like stocks, bonds, mutual funds, whatever? But they rarely talk about knowledge as an investment. And Warren Buffett once talked about the best investment is between your 2 years, right here. And investing in knowledge and investing in information pays the most amount of dividend. Yeah. So it sort of painstaking me to see people, which vehicle investment should I invest in? Well, let's first invest in you. If you're just getting started and you have no idea, you don't have a go-to decision matrix on how you make decisions on certain investment, well, it's time for you to learn how to invest in yourself right here before you get to the real estate, the mutual funds, Wall Street, which, by the way, every one of those investment vehicles can be dangerous without proper training. So make sure you do your due diligence and work on you.
Yeah.
You are the best real estate. You are the best investment vehicle that you can make on yourself.
Right. In terms of the specifics, Wall Street versus investment property. Now, if you're asking if you should give $60,000 to a stockbroker, I do not recommend that.
Right.
I do not recommend that at all. Long story short, without getting into too much of the specifics, I think I think if you put 60,000 in stock right now, not very good, because if you look at a lot of, again, research reports and data reports, you know we're in quite a bit of a sell-off right now in terms of stocks, in terms of the overall economy. So I say first get educated yourself. Now here's the thing, right? To kind of to add on to a lot of what Sam said, if you spend some money, right? If you spend a lot of money or whatever money, right? But spending money in general, investing in yourself, you won't even have to ask me that question,
right?
Of what should I invest in? Because the more knowledge you have, you'll already know. You know what I mean? Like for me, I'm a real estate investing guy. I'm an economics guy, right? I try and understand all aspects of economics and the overall markets. But I'd rather have somebody invest $50,000 of their own money in stocks, but they know stocks inside and out, than have somebody invest in real estate just because we're here and we're real estate guys. If you know stocks, if you know commodities, then do it, right? Like people should have bought gold 2 years ago. Back when a lot of people were questioning the reserve currency of the dollar in terms of its status in the global market, right? You should have bought gold 2 years ago, right? I wish I would have, but again, I don't know the commodities market. So, educate yourself, right? Spend that time investing in yourself. Then you won't even have to ask me that question. Now, is it cool to study a lot of different asset classes from real estate to stocks? Yeah, absolutely. Go for it. I mean, I do.
Yeah. So Matthew, so the next question is Matthew Tesimale. Okay, I hope I get your name right.
No, it's Tesimale.
Okay, well, I'm just gonna call you Matthew. I hope we were getting people's name right.
Yeah.
It helps if you
our last name's hard to
clarify.
Say. You know what I mean?
So Matthew's asking, I just graduated, got a new job, bought a new house, probably more house than we should have, but we have kids and want to settle. And I love the HELOC strategy and real estate investing, but how in my case, and I see that you have a little follow-up there, I just feel like I have to wait for at least a little bit of capital and equity to start real estate investment. So I guess I can segue then, and Daniel can kind of put the
go ahead. You go ahead, man.
But it goes back to our earlier conversation. If you're young, like I'm gonna go ahead and pull out the humble card and say we're still learning. Daniel's still learning. I'm still learning. We don't proclaim to be the real estate financial expert. We're just few steps ahead, I believe, compared to a lot of people. And we want to share our journey and experience, being that we're a few steps ahead. Now, that being said, what we looking back 5 years ago or 4 years ago, what we would have invested more time in is perhaps more knowledge and knowledge currency. And I think more so in not just techniques or strategies or even our HELOC strategy, but more so on relationship currency. Because the more relationship you build, as well as having more knowledge, it just becomes natural that you'll inadvertently attract individuals that want to work with you, and you'll quickly find out that your relationship currency as well as your knowledge currency, when paired together, can quickly give you the capital that you need. And Daniel can probably finish off. Of that.
And congratulations, congratulations, Matt, on your new home. Congratulations on your family, your wife. I hope how many kids do you have? These are things I'd like to know and get together with you on. Because I like to always get to know new people, right? But to kind of answer your question, I'd say you're in a much better position than I'm in. When we first started out in real estate, obviously you guys know our story. We were broke. I personally had negative $187.65 in my bank account, right? I mean, we were eating out of dumpsters. We had maxed out credit cards, right? Finances weren't good, but we got really good at learning to raise money. Learning to build relationships with individuals who had a lot of liquidity and they wanted to put it to use. And the question that I would ask you, and again, this goes back to investing in yourself, is, let me ask you guys a question, right? Every single one of you guys, all 20 of you on the live stream right now, is it harder to find people who have a lot of money and want to invest in real estate? Or is it harder to find people in this world to where they actually take in the time to really learn this craft of real estate investing, right? People who are actually going to know what to do with it, who are going to treat the investors correctly, who are moral, ethical, competent in all that they do. Let me ask you guys, right? Like how many more, like if I've got two groups, what group is bigger, right? The people with the money. Absolutely. Matter of fact, I would say that for every 100 people that have a minimum of $100,000 to invest and they want to put it somewhere and put it with somebody who, again, is the second group, I say for every 100 of those, there's one person who's actually good at what they do. But more importantly, they're honorable, they're ethical, moral with how they go about it. I've met tens of thousands of different real estate investors. And in all honesty, in a group of 1,000, right? Let's say like we went to a conference for real estate investing, right? If there was 1,000 real estate investors, if I had $500,000 and I was an investor and I was like, I probably would invest out of those 1,000, I'd probably invest in probably 20, right? 15 or 20. And if you really think about that number, that's 2%. That's 1% to 2%. But that's the reality based on what we've experienced and what we've observed. That's the reality. So Matt, to answer your question, how do you get started? You know, what about your take? I would say get really good at raising capital, and then don't take your foot off the gas pedal in terms of educating yourself in the real estate. Keep coming back to our live streams, asking questions, which you asked another question. Can I structure a seller carryback subject to with the property listed with the realtor? Yeah. You can. You absolutely can, as long as there is some kind of a financing premium or a down payment. So a financing premium, based on a lot of people, what they don't know is, if you don't know what a finance premium is, it's, long story short, a cash, right? It's some kind of cash that you pay for being able to take over the financing. And I've seen some banks, especially banks who have a little bit more flexibility, and community banks, right? As long as they're within regulations of the FDIC, what they do is that they'll charge premiums for taking over the existing financing. Now, in terms of a seller carryback, so for those of you guys that don't know what we're talking about in terms of a seller carryback, it's basically putting a note, right? Like, let's use seller financing in this example. It's basically saying, like, Sam's the owner, right? I'm buying a property from Sam, right? Sam currently has, let's say, $50,000 left to pay on his mortgage, right? Let's say his property is worth $100,000, right? And I want to buy it for $100,000. What's going to happen if I do a seller carryback in a seller financing? So obviously, a lot of you guys know what seller financing is. If you don't, then feel free to ask in the chat box and we'll break it down for you. But what basically is a seller carryback in the situation is that, okay, Sam, I'm going to buy your property for $100,000, but I'm going to continue your payments and pay off that $50,000 for you. Now, you still have $50,000 worth of equity that you want to make money on. So what I'm going to do is I'm going to draw up a note, a seller finance note for $50,000 that's going to start being executed on the minute I pay the final debt service on his first $50,000 of the mortgage that he currently has with the bank.
So basically what that translates to, let's say I go buy your house for $100,000. I get a mortgage for $50,000. The bank pays you the other $50,000. You are the bank. So we make monthly payments to you. In exchange, you give us the full ownership right. So it's kind of like taking partial payment. The other part that's not being paid fully cash, you're taking that as a loan, as a personal loan. We just pay you every month, and that would satisfy the transaction requirement.
So what if the seller unlisted? Yeah, in that case, that's even better. I don't want to say better because and I have a love-hate relationship with realtors. I'm going to be completely honest, guys. I personally think 90% of realtors are useless, and that's a strong statement. And I realize what I'm saying, but I wouldn't say something if I didn't think it was true. And again, this is coming from a guy who uses realtors. This is coming from a guy who has seen a lot of realtors. And based on my observation, and for me, I'm more of logic. Like, I'm a very much of a pragmatic. I'm all about logic. I'm all about observations. And if you have hurt feelings, then go to the corner and suck an egg. You know, like, sorry, what do you want me to tell you? You know what I mean? Like, and again, guys, I've been yelled at, or I've been called all sorts of names. And, you know, like, I had a mentor early on who was very harsh on me. And I'm, in many ways, I'm glad, you know? So I would say, like, realtors, if it's not listed, then great, it's fantastic. And again, there's realtors out there who provide tremendous value, right? There's a couple of realtors that I use right now, and I love them to death. Like they do really well at finding the deals that I'm looking for. They go the extra mile in providing me the data that I want. In that case, yes, I will pay you your commission all day long. And on top of it, I'll even give you a little extra, right? So I'm a big fan of value. So Jonathan, in your case of what if the seller unlists the property, then great. You have an opportunity to provide value to the seller without a middle person, without a middleman. And not only that, but it gives the opportunity for the seller to keep more of the money that, they're trying to make. And it also allows you to have a more open range and tunnel and segue of communication with the seller himself. So I say that's fantastic, especially if you have the mindset of you're trying to help and add value. Dude, more power to you. If you have that mindset, you'll have a deal any day of the week.
Absolutely. Yeah. So we don't see any other question down below.
Wait, hold on.
So I do see Oluyemisi. So this person's asking, please, what is the right time of the year in terms of month to buy gold bullion? Shall I still buy it now? Oh, can I still buy it now?
Well, you can do anything, right? You can do anything. Right. Now, if the question is should, I do not know. I can't answer that question for you because
me personally, I don't know about Daniel, but I don't know anything about gold. If you ask me a gold question, I'm like, dude, this is the only gold I have. Yeah.
Well, let me say this, right? I only study these different asset classes like stocks, commodities, bonds. I only study them for the sake of understanding the entire market. Right? Like that's what I know. Now, in terms of what I think you should do, again, it goes back to, and I'm not going to try and say your first name. Please tell me how to pronounce it, right? Because I want to be respectful. But I'm a big advocate of invest in what you know. So, Oluyemisi. Yeah, Oluyemisi. Yemisi, yeah. If that's what you know, if commodities is what you know, then do it. Invest in it. Now, if you're asking me the question of should I buy now in terms of this commodity, I'm going to probably safely assume that you don't know a whole lot about that asset class, especially if you're asking me that question, right? If the fact that you're asking the question in general, I'm going to assume that you don't know a whole lot about commodities enough to at least invest a lot of money into it, right? So I would say, find an asset class and invest. Now, do I think that real estate investing is the best thing to invest in overall? If you're looking at the chronological space of time and knowledge, then yes, I do think it is, because I don't think any other asset classes offer what real estate can offer, right? In terms of appreciation, and not only appreciation, but being able to have appreciation in 4 different ways. In terms of control, because one of the things that Sam and I are huge on is what do you have control over, right? And I'm not saying control as in like a control freak, like I need to control no. I'm talking about having control over your own financial destiny. That's what we're talking about. Having control over your own finances and allowing your own brain and allowing your own knowledge to be able to dictate, right? Like, don't get me wrong. Like if somebody makes us money, that's fantastic, right? But I'd rather make money knowing it's something that we did and we had control over than giving money to somebody else and saying, here, do something with it. And so, Misi, right? I would encourage you to study up on different asset classes. And I understand that mindset of, we want people to just tell us what to do because it's easier, right? Because it's simple, because, it's not complicated, But again, I would encourage you guys to, especially if you're entrepreneurs, get in the mindset of getting that research, getting that data, and making these decisions for yourself. And it really is self-leadership, and the minute you have somebody tell you what to do, right? At the minute you have that mindset of you want somebody to tell you what to do in terms of where to invest, that's a very dangerous position to be in, because there's a lot of people in this world who sound really smart, who sound like an expert, who they have another YouTube channel, or they had some little success, right? Who you may not even be able to verify whether that's true or not. Yeah. Like when I tell people we have 77 doors, like we have 77 doors.
79.
79. I'm sorry.
Yeah.
Right.
Gotta keep a track.
Right. But like when I tell people that like we're currently doing 7 flips, you know, around the country, like we have 7 flips. We're closing on one literally 2 days from now.
So yeah, we're selling on the selling side.
On the selling side, right?
Side,
and we're making like $60,000 off of it. You know what I mean? So like when I tell you that we do these things, we do these things, right? So I would say if you have somebody that like is telling you where to invest, I would look into, you know, what's their track record, how verifiable is that? Like, did they actually do those things? Ask around other people to see if they're actually moral, ethical, and they are good at what they do. And also figure out for yourself if what they're saying is actually true. And also if there's some financial gain and financial incentive for them to tell you what, you know, like that. And this is why I can't stand like CNBC and CNN, because there's so many things in the background to where these people are financially incentivized to tell you what they're telling you, right? You know? So again, a lot of people that's smart or they look smart, they present themselves as an expert. They're really good at that. I know many who are that way. And yet they don't walk the walk or talk, you know, they don't walk their talk, whatever the phrase is, the rapper, whatever says, walk it like you talk it.
So guys, go ahead and leave any more questions. We may just end it here, but if you have any more questions, we'll take it for now. As a reminder, guys, go ahead and subscribe to the channel, as we are going to be doing this every single week in regards to real estate investing. This Wednesday we're going to do a HELOC strategy. So I'll be on live answering your question. By then, I'm hoping that we'll have our phone system up so you guys can call. And I'll have a headphone on, and we'll have an actual conversation instead of doing just a chat. Right. Very monotonic. But guys, go ahead and subscribe so that you get notified as far as when we do our live, any sort of live sessions. Tomorrow, Tuesday at 12 p.m. Central Time, we are going to be releasing a new video. The video is titled "How to Buy Your First Rental Property Without Using Your Own Money or Credit." So we're going to be launching that tomorrow at 12 p.m. Central. Be sure to subscribe to get notified on the new releases of our video. And then we may have another video coming up on Thursday. We're not quite sure yet. We got to check with our editing team. But guys, if you don't have any other questions, we'll end our live session here today. Go ahead and type away if you have any questions. We'll be doing this again next Monday.
Every Monday,
11 a.m. Central Time, which is 12 p.m. Eastern, 9 a.m. Oh, I'm sorry, 12 p.m. Eastern, 9 a.m. Pacific.
What do we call this?
So we're just calling this real estate Q&A.
It's not Motivation Monday.
We're not calling it Motivational Monday. We're not here to give you guys. You guys should be motivated.
How about Mastermind Mondays? How about that? Mastermind Mondays. We got a name.
Yeah. So Q&A. So guys, if you don't have any other questions, we'll wrap up the session here today. We got one more. Boom.
Lorenzo Delgado.
Lorenzo is asking, just flipped for $180,000 profit. Going to buy my first rental and possibly second. I've never done rentals. What is a good direction?
Well, first off, congratulations, dude. That's freaking awesome, man. That you're making 180. Dude, think about it, man. You have made more in this deal than 99% of Americans make in a year. Like, think about that. Like that's how awesome real estate investing is. Well, if you do it well, right? Like that's how awesome it is. So I've never done rentals, good direction. So it depends, right? Again, I hate to use that word, it depends, but it really does, depending on where, number one, you're investing in. So I think the areas what I'm investing in is obviously great, but people don't realize like the places where I do our deals, I usually spend literally 2 to 3 months studying that market. And I'm talking like I'm staying up till 2-3 a.m. in the morning. I'm 3-4 hours in a row of just reading report after phone call after phone call, of trips after trips, of literally going in on that market and figuring out every little detail. So I usually do about 2-3 months of that before I actually even do a deal. Don't be fooled by numbers, right? Like people say numbers don't lie, and that's true, but numbers can be deceiving based on the context. So what if I told you guys that it was 32 degrees right now? 32 degrees. What if I told you, right? For those of you guys that live in America, you say, oh, that's cold, right? We live in Chicago, so for us, that's shorts weather. But for those of you that live around the world, 32 degrees Celsius obviously is not the same as 32 degrees Fahrenheit. And that's the same thing, guys. You can say 9% cap rate. I mean, that sounds great. Okay, but where? Yeah. You know, is it 9% cap rate in the south side of Chicago? Because if it's 9% cap rate in the south side of Chicago, then you're screwed, right? Because that's a terrible deal. But if you say 9% cap rate in downtown Chicago, right? That's a phenomenal deal
Mhm.
because, you know, like deals in Chicago, that's 2, 3, 4% cap rate in downtown Chicago, right? So first off, I would say, where are you doing it? What's the context of the numbers in terms of your first rental that you're possibly looking at right now? Because I'm listening right now. I'm hearing or reading. You said you're going into your first rental, possibly second. I'm assuming that you have these deals already in line, and maybe you're already doing your due diligence. So I would ask, you know, what is the context of those numbers? And what you're getting into.
I would say this: check out the video that we're releasing tomorrow.
There you go.
We're gonna go through a step by step. It's 12 steps of how to buy your first rental property without using your money or cash. Maybe you might even take that $180,000. Don't even use it. Set it aside as a reserve, and maybe bring in a partner. And I don't know. That might be the direction.
No, I wouldn't do that.
It might be the direction you want to go.
If you have $180,000, and especially if you're in a position, and again, the second thing that I was going to say is that it depends on your personal finances.
Right.
You know, so if you just made $180,000, but at the same time you're in a financial position where you're not hurting for money, you know, and you're driving a nice car, you have a house, you have reserves, and you have things in line, and you know, depending on your personal finances, if you want to put that $180,000 towards a rental, towards like buying a 6-unit building, or putting a down payment on a 10-unit building, go for it. You know what I mean? Absolutely go for it. Now, obviously, be smart, and, you know, don't over leverage yourself, and at the same time, making sure you're getting your most bang for your buck in terms of your $180,000, because, you know, 180 grand, that's a lot of money, guys. You know, that's a lot of money. Again, that's more than what 99% of Americans make in a year, you know? So even, and guys, I don't care if it's $5,000, $2,000, right? Always be careful, always be cautious, always do due diligence. So again, Lorenzo, it does depend on your personal finances. You know, if you want to talk more in deep about that, feel free to email us. You know, Sam, I don't know if you could put like our emails.
We'll do this. Let's see here, Lorenzo. Go and cut. Let's do this. I don't know how urgent you are about this, but shoot us your email. We'll send you an email. We typically don't like to have all of our emails everywhere. But go and shoot us your email after we're done with this live. We'll reach out to you, and then we'll go from there. Because I feel like once we make our email public, it starts to get crazy.
Because there's a lot. There's a lot we can do to dissect.
So Lorenzo, go and check out the video tomorrow. We're going to be releasing tomorrow at 12 p.m. Central. 12 p.m. Central time. And I think some of the questions that you may have will be answered. Let's go and get Jonathan here. Jonathan is asking again, if you do a wholesale deal, how do you dodge a double transfer tax? So I'm guessing this has to do with your state and municipal laws. You may want to check with the title company. Most title company could probably answer this question for you. And again, it depends on your municipal laws. Like here when we reinvest west suburbs of Chicago, if you do a single close, or double close, a good title company may help you, assist you, so that you don't end up having to pay double transfer tax. And I'm guessing you're referring to doing double close, because in a double close, you're essentially buying and then selling the real estate right there and then in a matter of a few minutes. You may also even have an attorney do an assignment for you. There must be a different contract or an instrument that can help you avoid this. Again, I don't want to prescribe anything for you here in this live YouTube channel.
Especially because
talk to an attorney.
Jonathan, because we don't even know where you live.
Right.
And we don't even know where you're doing deals. And, you know, Sam and I have to be really careful because, you know, like obviously, guys, we're not attorneys. You know, we're not CPAs, we're not accountants, we're not even real estate professionals. What we are, we're just real estate investing entrepreneurs who happen to have a lot of great success. And we're doing this because we want to give back. So, Jonathan, I would ask your real estate attorney, which if you are a real estate investor, you should have a real estate attorney.
Right. Rob is asking, should I buy a 4-unit with a commercial financing or residential financing?
Well, that's kind of
case
contradictory because a 4-unit is technically residential.
Right.
But if you're asking, should you get a commercial loan to buy a 4-unit? Again, I mean, it does depend. I'd say go with the one that's got better financing. Go with the one that has better terms, better leeway. Typically, a lot of banks, if you are using a residential, mortgage or residential financing, they do require that you live in the building. A lot of financiers do that. So I'd say overall, go with the one that has better terms. Go with the one in which you're going to build more equity faster, and go with the one that has better cash flow. So I mean, I don't know. Again, with not knowing too much of the situation.
Rob's also asking, should I have an LLC 2 years before the purchase? Okay, so I can see where this is going. So Rob, I think what you are asking is, should I get a loan using my LLC? And I need to be able to. So most banks will be looking at an LLC to get a. And this is typically more true with an unsecured business type of loans. If you're doing a business loan, business line of credit, any sort of business, and not asset based, because if you do an asset based, it becomes a completely different underwriting criteria. But if you do a non-asset based business loan, you do need a 2 years of business history shown. Some banks may require up to 3 years. Now, when you're buying an asset, when you're buying with an asset-backed financing or asset-based financing, that really typically won't matter. Banks will have you'll have a harder time financing a real estate through an LLC overall, anyways. Whether you're an experienced investor or you're a new investor, there's a different criteria when you're trying to finance through an LLC.
Even though, like, and know this, right? And we bought a property. I bought a 36 unit apartment building using bank financing. So even if you're buying it under an LLC, and typically what I do is that, my go-to right now is whenever I buy a piece of real estate, I'll make the LLC like right there, and then I'll just give my investors a percentage of that LLC. And these are guys that I've built relationships with for years, right? For a long time, right? So in terms of bank, even if you go bank financing, whether you buy it under an LLC or not, the banks are going to ask for personal guarantees. They're going to ask for every single little piece of your financial information.
Right.
So for me, like every year I have to provide a personal financial document, like personal financial, basically my assets and balance sheets, my tax, like I have to show them my life insurance information. I have to show them every single asset I own. Every single thing that I do. So either way, whether whether the property is being held under an LLC or you, does not matter. The banks know that in both situations, you are the operator. Right. And they're not only going to look at the 4 unit, right? Because that's what you're asking, right? 4 unit with commercial financing or residential. They're going to look at that 4 unit and they're going to do their numbers. They're going to see, all right, what's the return? What's the IRR? They're going to analyze it like any other real estate investor would, just to kind of see the safety and the risk assessment of that asset. And the second thing is they're going to look at you. They're going to look at, all right, is this guy able to manage this? Is this guy competent? Is he a good real estate investor? And depending on that actually will dictate your terms. So if the average person right now, right, if the average person walked into a bank and they asked for a commercial loan, chances are they're going to get a 5.5% return. The last time I went into a bank, right, and it was pretty recent, and I asked for a commercial loan, I got 4.65. Right. And again, it's because for us, we have assets, we have these things, but we're also very knowledgeable in the real estate investing world. That's why Sam and I always push, like, invest in yourself, because it has way more benefits and dividends than what people think.
So overall, getting financed through an LLC is going to be rather difficult, especially if you're a beginner. Again, I'm not an attorney, neither is Daniel, so this is not a legal advice.
Nope.
But an LLC will give you legal protection. There's some liability protection that the LLC may afford you, as long as you honor your LLC's operating agreement, as well as some of the things that you're establishing. Make sure you consult with an attorney, because again, we're not attorneys, and LLC may or may not even help you get financing. It may sometimes hinder you in most cases, but it protects you in terms of the legal side. We got Ayub Abdi is asking, what are requirements for an FHA loan? I want to buy a duplex.
So I'm guessing Ayub.
So
Ayub. So I'm guessing you're asking this question because you want to live in one unit and then rent out the other. I'm not going to lie to you. I'm going to be very honest. I've never gone through the FHA process. I, for one, never needed to. And another thing is I kind of don't want to, especially because I like my house. And I've never been in a situation where I'm buying a 3 or 4, but I am full aware that that's what a lot of people want to do. A lot of people, especially today, they're drawn to the whole concept of, buy a 3 flat. You live in one, you take care of the expenses with one, pay the mortgage with the one, right? I know that's very attractive. So again, I simply do not know the FHA requirements. I would talk to an FHA broker, or somebody who is attached, or an FHA expert, so to speak. And obviously take it with a grain of salt, because obviously they are going to have, they may have their own agenda. in terms of their financial gain by talking to you about it. But what I guess what I can answer for you is, is that a good idea of, buying a duplex or buying any piece of real estate via FHA, right? For that one, I do think, depending on where you are in life, I think that is a good idea. I think if you're in your 20s and you're not married, or you're married but you don't have kids, right? And it's an area that you genuinely want to live, and you want to be there for a while, or you want to eventually just want to manage it yourself. But I think that's a great idea. Now, I have heard strategies to where just using FHA loans to go from one building to another every single year. I think that's the stupidest thing that anybody has ever said. Using FHA to basically self-leverage yourself and buying a piece of investment property, using FHA, living in it for a year, doing the same thing for another property, especially if these are like 3-4 unit buildings. I think that's a terrible idea. You're putting yourself in a situation where, for one, it's a government-based financing. And what did we say 30 minutes ago about the government in a year and a half?
Yeah. I don't want to make this a political show, but
it's not, because look, I'm just talking about financing.
Well,
here,
but
right?
It's just my own take is, if you have government involved in any sort of financing, it's bound to go somewhere like bad.
The reason why I bring it up is because a very high majority of what's called government bonds are coming due in 2020. Yeah. That's going to put the government in. It doesn't matter who's president, right? This is not left or right. This isn't forward, right? I'm not advocating any political candidate or anything like that. We're not Democrats or Republicans. We're not any of that. We're Christians is what we are. Yeah. But it doesn't matter who's president. Those bonds are coming due in 2020, no matter who's in office, right? Those are coming due, and FHA most likely will be wiped out. There's the same thing that's happened in 2007, 2006, right? We had, subprime mortgages. It's the same thing. Whenever you have a situation where financing is too easy, and you don't have to put in as much down, right? Like an FHA where you only have to put 3% down, right? And again, that's why I am absolutely sick and tired and just pissed off at these real estate investing platforms that are literally telling people who don't know any better to use FHA to buy a piece of investment property, live in it for a year, and do the same thing with another piece of property. Like, that drives me crazy. You're literally asking people to jump off a bridge, and maybe 1% of you will survive. Like, the fact that these people have the audacity to tell you guys, right, and the overall real estate investing market and audience and industry to do this is absolutely sickening. Like I have seen this happen before, but with different instruments, right? Like, I've read case studies and met physical people and have heard stories of people who took advantage of subprime mortgages, of financing being extremely easy, to buy pieces of real estate year after the next, which you're basically doing the same thing with FHA, is what people are being told to do by these platforms. I'm not going to name names, but I think you guys know who I'm talking about. Right?
Yeah, as you guys can see, in this given timing and the context in our market, we are not a big fan of the FHA. And there's various reasons. We'll probably get to that next week.
If you're a flipper, yes, it's phenomenal, right? Like, all my fix and flips are in FHA hotspots, right? Which, again, if you're a real estate investor and you want to make money, that's what you want to do, right? Again, a part of my research was the financing. Where are these hotspots for financing?
He's referring to the selling end, not the
buying selling end.
Not
right.
So don't buy with an FHA.
Right. I love being a seller in an FHA hotspot, because it means financing is easy. What does that do? Drives up the price. The fix and flip that I am selling, right? We're closing on selling on Wednesday. We're getting $25,000 more than our asking price. Yeah. All right. It's because I did the research. It's because I identified this as an FHA hotspot. We know what's going to happen. So for me, when I heard that we're getting $25,000 over asking price, I was not surprised. If anything, I was expecting that. Now, is it a lot higher than what I thought? Yeah, absolutely. Right. Make an extra $10,000, $15,000. But that's the point. That's the point I'm trying to get. Right. Yeah. Do not do that. Do not. Right. And if you're doing it one time to where you're using FHA, you're going to live there for a long time, and you want to manage it yourself, and you're doing this to get free housing. Yes, all power to you. Do it, right? But if eventually, if your plan is to, use FHA, buy a property 1 year and do the same thing and move out, right after a year, you're setting yourself up for failure.
Right.
You absolutely are, right?
Yeah. All right. So guys, we are coming to a time where we do have to close. So
And I'm starving.
There's
so
no exception. Yeah, we do need to get to lunch.
hungry.
So guys, appreciate you guys being here.
For
Love you.
knowledge.
Love all of you guys being here, asking questions. I hope you guys got some incredible amount of value from being live with us. So every Monday, 11 a.m. Central Time, be here. We'll be here answering your question, whether it's myself, Daniel, both of us here. This is the first episode. So what you need to do from here is go ahead and hit the subscribe button. We got plenty of other videos on our YouTube channel about real estate investing, as well as our infamous HELOC strategy. We'll be back next Monday. And for those who want to have questions answered about the HELOC strategy, we'll be back here on Wednesday at 11 a.m. Central Time. Love you guys. Appreciate you guys. And I will see you guys next week.
Next Monday.
All right. Take care,
Don't
guys.
be late.